In this presentation, we will take a look at adjustments for AGI related to alimony paid. Remember that adjustments for AGI are going to be the above-the-line deductions, not the itemized deductions. Here is an example of the Schedule 1 where the adjustments for AGI will be. We're down here on line 31A and B. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Alimony is going to be an interesting situation for 2018 and 19 because there are current changes to alimony. Those changes starting in 2019 are that alimony is not deductible for the payer and is not included in income by the recipient. This rule will apply to divorce or separation agreements after December 31st, 2018 and could also affect agreements that have been modified after that date. What this means in essence then is that we need to know the old rules so that we can still apply them as they are applicable. We need to know what the cutoff date, and then we need to know what the new rules are. We need to know those rules for tax reporting purposes, of course, as we record these taxes so we can properly record them. We also need to know them if we are in a position where we're going to help or give advice in terms of the agreements of a divorce or modifications, because oftentimes this will be done as a legal process. They'll come up with the agreements for the divorce, and in that agreement will need to be taken into account the tax consequences of it. And that's going to be really important. If an old agreement is modified, is there going to be adjustments with relation to how the taxes will be treated? That could adjust the way the modification will happen. That's relevant information. And if any new divorces are going to happen in the future, they need to take into consideration that they may not be able to follow the same kind of standard rules in the past because the standard rules were based on tax consequences that are now different in the current setting. So this is one of those rules that probably are better going forward because it removes the taxes from a divorce, which is kind of nice, or does that more so. But as it's input, then we're going to have this transition period where we're kind of doing two things depending on the cutoff date. To understand this better, we need to get some concept of the types of payments that can happen within a divorce agreement, the old rules, the rationale for them, and then the new rules and the rationale for them. So there's three potential payments that typically will happen within a divorce. We have the scenario here. We have two individuals that are getting a divorce, and now there could be payments from one to the other individuals. How could those payments be categorized? Typically, there's three ways that they could be categorized, either as alimony, child support, or property settlement. Now, if they're part of like a property settlement, if it's just basically the two individuals, what this means in a divorce is we have two individuals where you can kind of think of their property as being one. They were joined as one person from a property standpoint, and we're not going to get into joint property or separation of property, but separate property. But if you can think of them now being two again, so we have to split that property up. And if there's a property tax payment that is just the splitting up of the property, there's no tax consequence there because they both owned it as one before. You can think of that as being the case, and then when they split, then you're just distributing the two between the two halves. So there's no income related to that in that scenario. These two items, when we think of alimony and child support, this isn't really a splitting of the current property. This is possibly us seeing income being earned by one spouse or the other in the future, which is then being paid to the other spouse for one reason or the other, either because of alimony or child support. From a tax standpoint, this used to be a big deal under the old rules because there's different tax consequences related to alimony and child support. From a legal perspective, the legal terminology was also a big deal because it wasn't always clear whether the payment is alimony or child support. So we have to kind of think about what is it alimony or child support? And when making the agreement, it would be best to make that very clear and make that part of a very transparent portion that both sides know and why it would be allocated as alimony or child support. So from these three, the alimony is the only one that could have a tax consequence. So the alimony is the one that's going to be dealing with taxes. The other two, if there's child support paid, then typically we are not going to have a tax consequence, meaning the person paying the child support typically cannot deduct it, and the spouse receiving the child support will typically not have to include it in income. And notice what happens there if the spouse receiving the income, of course, wants to get the money and not have to report it. They don't want to have to report the income because then they're going to have to pay taxes on it. The person paying the alimony, the spouse paying the alimony, is going to want to deduct it just so they can get some benefit on it. If they're going to pay it, they might as well be able to deduct it. Child support is then not included as income on the recipient, which is good for the recipient, but it's not deductible typically from the payer, which means that the payer in the past always had basically an incentive to try to categorize things as alimony as opposed to child support so that they can get a deduction. But if they did so, then the person receiving the alimony usually had to record it as income. So alimony under the old rules had to be recorded as income. So the requiring of one spouse to make a payment to support the other spouse is what alimony is. So if it's going to be alimony, it's got to be paid in cash, must be required under provisions of the divorce agreement, and payments must end at the payee's spouse's death. Why is this important? Because under the old rules, it used to be that the person paying the alimony is going to want to try to categorize their payments that they made as alimony. And so they're going to say, hey, I made this payment, or I paid for this and that. Can I deduct that? And the answer would be, typically under the old rule was, well, you can only deduct it if it was a cash payment. It's got to be required under the divorce agreement. I mean, if you paid more than what's under the divorce agreement, it doesn't count because it's not alimony as is defined under the divorce agreement. And a lot of times, again, the language of the divorce agreement may not say, hey, this payment is alimony and this is child support. They may have language that says something like the payments will continue until the child reaches a certain age, or they may have language saying that the payments will cease upon the death of the spouse. And of course, if it's the death of the spouse, the assumption then would be that the payments are actually for the spouse, to support the spouse after the divorce, as opposed to supporting the child, which you would think would be the case if there was an age restriction. So that kind of terminology within just kind of legal terminology, not being specific on alimony and child support, but having kind of that language in there is how we had to divide those two things out. Under the new rules, going forward, the alimony is going to be more like child support, where the alimony is going to be saying that the one spouse will pay it, but they don't get to deduct it, and the other spouse that receives it doesn't have to include it in income. Now, when we first consider this law, we probably come to the conclusion that the payer is the one that doesn't benefit from this law because, of course, they lose the ability to deduct the alimony, and that is the case. The payer is going to lose the deduction, but it's not as big of a change as we might think, because it would be more of a big change, in other words, if this law was to be implemented retroactively. In other words, if we went back and then looked at the divorce agreements that have already been made, and then we adjusted this retroactively so that a deduction that someone had under the prior agreement is now something that's not deductible, that would be a bigger difference, a bigger deal, because the agreement should be, if everything is taken into account, taking into taxes account. Now, if we're talking about a divorce going forward, under the new rules, it shouldn't have as big an impact as you would think, because now we're able to take taxes out of the situation. So the divorce agreement itself should be adjusted to compensate for the fact that there's not an deduction. In other words, if you have two people that are negotiating fair terms and they were completely transparent with each other, which would be an ideal situation, then they would account for the fact that there's going to be alimony is going to be deducted, and they would adjust the amount of payments that would be made. And so if, on the other hand, now we're talking about the taxes being removed, we're simplifying things in some ways by not having taxes being influencing the divorce agreement. And hopefully that will make it easier and also allow people to be more transparent. And then the alimony payments can actually be possibly less, because the recipient doesn't have to report it as income and pay taxes on it. So hopefully going forward, it'll be a good thing that'll make the negotiations a simpler process. However, in order to do that, the standard templates that have been used in the past that may be taking into consideration alimony payments and the benefits of of the alimony payments as a deduction and the cost of the payments for the recipient, those kind of templates, those standard payments that people might have put together, are now going to have to be adjusted for the fact that the taxes have changed, the consequences have changed, and the negotiation then should change accordingly. For more accounting information and accounting courses, visit our website at accountinginstruction.info.